Quantitative easing, a policy of increasing the money supply by buying financial assets such as government bonds, has been used as a measure to stimulate the economy and address economic downturns. But this economic tool has also had implications for wealth inequality and politics. In this video, we will explore the wealth politics of quantitative easing and how it has affected our society's distribution of wealth. Consequences for developing countries. Quantitative easing is an important monetary policy tool used by central banks to stimulate economic growth in developing countries. It involves the purchase of government bonds and other financial assets to reduce interest rates in order to encourage investment and spending in the economy. However, quantitative easing may also have unintended consequences for developing countries, such as increased inflation, currency devaluation, and economic instability. Increased inflation. In developing countries, it has caused increased inflation, which can have a significant impact on the well-being of their citizens. Inflation is defined as the percentage change in consumer prices over a fixed period of time. When inflation rises, it means that the value of money decreases over time. If there is an increase in inflation, then goods are more expensive and less useful. The analysis of this paper will explore how quantitative easing has impacted inflation rates in developing countries by first explaining how quantitative easing works to create inflation, and then discussing some potential solutions for mitigating these effects on developing countries. Central banks reduce the amount of cash in circulation by buying government bonds, thus increasing the money supply. The central bank then prints more money and uses it to buy other bonds, again leading to a decrease in cash reserves and an increase in total reserves. This causes inflation as prices rise due to increased demand. In order for this policy tool to work properly, quantitative easing must be undertaken by both monetary authorities because they need each other's support and ability to print new notes. Quantitative easing increases inflation because it increases the supply of money in the economy, thereby increasing demand and suppressing interest rates. Quantitative easing is different from the process by which commercial banks may borrow short and lend long. This process involves extending credit to those that need it, while quantitative easing provides increased cash reserves to those that already have loans with the central bank. Another difference is that quantitative easing is done on the open market, whereas commercial banks do it by lending. For example, when a bank lends money to a company, the bank does not create new money. Instead, it simply issues a new loan for which it receives interest payments. When more people want to borrow money and this creates an increased supply of loans in the economy, then there will be less demand for those loans, and interest rates may fall as well as cause inflation. What should developing countries do to solve the issues? As a result of quantitative easing, developing countries are facing the increasing challenge of rising inflation. In order to ensure sustainable economic growth, it is important for these countries to properly manage inflation. It is important that a developing country takes some steps to successfully manage inflation and promote economic stability. Rising inflation places an increasing burden on the economy, which ultimately leads to slower economic growth if not managed properly. When the economy is weakened due to rising inflation, it becomes difficult for developing countries to meet their development goals without any growth at all. In order for developing countries to sustainably promote economic development and avoid bankruptcy, they must manage their rising inflation effectively. In order to manage inflation effectively in developing countries, it is important for them to implement macroeconomic policies in line with their primary goal, which is sustainable economic development. In order to successfully manage inflation, a country must implement price controls and promote active monetary policy. For example, Thailand implemented a fixed exchange rate system during the period of high inflation that resulted from past years. The Thai government also implemented price controls on certain goods such as beef, rice, and vegetables intended to limit inflation. A fixed exchange rate system is a monetary system in which a government fixes the price of one currency in terms of another currency or vice versa. It may also fix rates for other economic variables such as interest rates, exchange rates between base currencies, inflation rates, and so on. In a fixed exchange rate system, the central bank, usually, cannot increase or decrease its official exchange rate to control domestic inflation and international competitiveness. Instead, it must rely on indirect measures such as controlling the money supply. The United States adopted a system of fixed exchange rates for the dollar in 1973. In 1978, President Jimmy Carter announced plans to devalue the U.S. dollar, which caused a strong inflow of capital into the United States. This sudden inflow of capital allowed President Carter to increase government spending without increasing taxes, and as a result, inflation increased as well as unemployment outside of the government sector fell markedly during his presidency. There have been significant debates over the effects of fixed exchange rate systems on economic growth and inflation, but many economists are in favor of them. Conclusion: Quantitative easing, QE, has been an important monetary policy tool for central banks around the world during times of economic trouble. QE has been used to stimulate the economy by keeping interest rates low and increasing the money supply. The effectiveness of quantitative easing, however, remains a matter of debate. While QE may have had positive short-term effects on economies, there is evidence that it can have long-term detrimental effects as well. Ultimately, the success or failure of quantitative easing will depend largely on its implementation in specific contexts and its long-term impacts on economic growth and inflation. Thank you for watching.